Ultratech Cement reported a mixed set of numbers for Q1. The company's net profit and revenue ahead of street expectations. Margins missed the mark. On the yearly basis, the company's net profit jumped nearly 7%. Revenue was up 17%. Domestic sales volume grew 20%. JSW Steel beat street estimates on all fronts in the first quarter, that is. Net profit nearly tripled on a yearly basis to over 2,400 crore rupees. Revenue jumped by 11% to more than 42,000 crore rupees. EBITDA margin also ahead of expectations. And Ashok Leyland posting a strong set for the first quarter, beating street expectations on net profit and revenue. The company's profits jumped over 8 times that of the same time last year, while revenues are up over 13%. Margins also beating street expectations of 8.7%, coming in at 10%.
The star of the show really was the retail business. We'll talk more about that. But if you look at it, the oil to chemicals business was better than what the street was estimating, definitely. But the retail business with its 20% growth is what really took our breath away. Now, the Reliance Retail saw over 555 new store openings, and it was a steady quarter from Reliance Jio as well. We'll talk more about that later. The subscriber addition was strong, the ARPU increased. The balance sheet of the company overall has also improved along with the P&L. So the net debt is now flat quarter on quarter, adjusted for the JFSL demerger. Just to give you the core numbers, they'll come up for you on your screen. Revenues on a consolidated basis are at 2.07 lakh crores compared to 2.19 lakh crores same time last year. On a year-on-year basis, the core EBITDA and the margins have improved. Margins have improved to 18.3% versus 17.3% year-on-year, while the net profits are down almost 11% on a year-on-year basis, coming in at 16,011 crores. The management commentary has also been strong. But as I said, consumer-facing businesses was the star of the show. So let me toss it across to Reema to talk about Reliance Jio. Reema.
It's a steady showing from Reliance Jio. The company has clocked in a 2.8% quarter-on-quarter revenue growth. On a year-on-year basis, revenues are up 10%, but EBITDA is up 15%. So double-digit growth for both the top line and on the operational performance, and margins have expanded even further to 52.3%. The average revenue per user, or ARPU as we call it, continues to inch up. In the current quarter, it's 180.5. In the comparable quarter of last year, that's last year, it was about 175 to 176. Subscriber growth has been very, very strong. In the current quarter, the company has added more than 9 million subscribers, and this is the best that we've seen in the last 4 quarters. But even beyond the numbers, the company's data traffic is up 28%, 60% of the industry traffic. The company has said that on the fixed wired broadband side, 80% of the net additions are going to Reliance Jio. The company has also successfully done the trial of 1 million new phones of Jio Bharat. So that's also, on track. And the company has said that they're on track to complete the pan-India 5G coverage before December of 2023. So all in all, it's a very good showing from Reliance Jio. Absolutely no disappointments. But the star has clearly been retail. So Mangalam, it's over to you.
Star indeed, and it's a record-shattering quarter for the retail business. Highest ever revenue, highest ever EBITDA, highest ever margins, and on a high base as well. Revenues up 19.5%, closing in on that 70,000 crore mark per quarter. EBITDA has jumped even better. In fact, it's a 34% jump year-on-year that we are seeing in the retail EBITDA, and the margins year-on-year have improved by 80 basis points, 7.4%. If you look at the internals as well, they've added 555 new stores, taking their overall retail footprint to 18,446. Almost 25 crore people visited Reliance stores in this quarter. So highest ever footfalls out there as well. Digital and new commerce doing extremely well for them, account for about 18% of their overall revenue. And going forward, the triggers, they are integrating the Metro AG business with them as well. Groceries saw a 59% growth year-on-year, led by Smart and Smart Bazaar. And the Campa acquisition did well for them. The beverages category grew 11 times. So clearly the star of the show, retail business with an expanding portfolio and improving operating leverage as well. But for everything else, we have oil to chemicals. Sonal, how did that look?
Well, for oil to chemicals business, it was a decline on a YY basis, but it was much better than what the street was working with. And this decline came in largely because of lower cracks. They have now normalized from record high levels that we saw in FY23. And that's the reason that there was a decline of 23% in EBITDA on a YY basis to come in at 15,271 crore rupees, but much better than what the street was working with. Around 14,900 crore rupees were the estimates. Margins at 11%, but if we look at the trend as well, you'll see that it was FY23 which was seeing abnormal profits there, and that has normalized in Q1 of FY24. But that is about oil to chemicals business. It is really the oil and gas business which is fired on all cylinders. It is a multi-quarter high margin number for the oil and gas business. Their EBITDA is up 47% at 4,015 crore rupees. Their margins at 87% versus 75.5% on a YOY basis. And the company going forward is very bullish on the trends as far as the oil and gas space is concerned as well, because the third cluster in the KG-D6 basin has started production, and they expect to increase their gas production by 50%, and they will cater to around 15% of India's consumption needs as far as gas is concerned at 30 MMSCMD. So good numbers coming in from the oil and gas space as far as Reliance is concerned.